Hello guys, good day. Welcome to another video lecture in ACC 311, Income Taxation. In this video lecture, we will be discussing about taxation on individuals with emphasis on active income. Individual is one of the different types of taxpayers that obviously pays tax to the government. And these individual taxpayers, guys, are divided into several types. But before we proceed with the different types or different kinds of individual taxpayers, let us first operationally define what is a citizen. So, citizen are those citizens of the Philippines during the adaptation on of the February 2, 1987 Constitution, those whose fathers or mothers are citizens of the Philippines, or those born before January 17, 1973, the date of the adaptation of the 1973 Constitution of Filipino mothers who elect Philippine citizenship upon reaching the age of majority, and those who are naturalized in accordance with the law. So, if an individual fits with the definition of a citizen, then therefore it can be called as a Filipino citizen. Now, let's proceed with the different kinds of individual taxpayers. First, we have resident citizen. So, when we talk about resident citizen, these are citizens, Filipino citizens residing in the Philippines. So, if you are a Filipino and you are living in the Philippines, then therefore you are classified as resident citizen. Another type of individual taxpayer is our non-resident citizen. So obviously, when we talk about non-resident citizen, these are citizens staying abroad for at least 183 days. Meaning, you are a Filipino individual but not living in the Philippines. Or again, it qualifies that a citizen who is again in abroad for at least 183 days or majority of the days in the year is considered as a non-resident citizen. So in this case, guys, we have specific consideration for non-resident citizen. If you are an immigrant, that means you leave the Philippines to reside abroad as an immigrant for which a foreign visa has been secured. So that means you are considered as a non-resident citizen. Or if you are a permanent employee leaving the Philippines to reside abroad for employment on a permanent basis, or if you are a contract worker leaving the Philippines on account of a contract of employment which requires him or her to be physically present abroad most of the time. So again, most of the time, that means that should be 183 days or more. So if you are working abroad with a contract for more than 183 days, then therefore you will be considered as a non-resident citizen. Take note, citizens who work outside of the Philippines for at least 183 days due to a contract of employment with a Philippine employer, take note, Philippine employer are not considered as non-resident citizen because they are not considered employed abroad. So even if they are physically absent in the country, but they are employed by a Filipino employer, then therefore they are considered still as a resident citizen. So as long as they are one of these three um, recognized non-resident citizens, then therefore they would be considered as one. Another type of individual taxpayer, guys, is our resident alien. So when we talk about alien, obviously these are foreigners, no? Since it's a resident alien, then therefore they are alien or foreigner staying in the Philippines for more than 1 year. And lastly, the last kind of individual taxpayer is our non-resident alien, an alien or foreigner who stayed for less than 1 year. So we have two types of non-resident alien. The first one is engage in trade or business or NRAETB. So they are alien foreigner who stayed in the Philippines for more than 180 days in any calendar year. So 180 days does not need to be consecutive. As long as the cumulative number of days is 180, that 180, then therefore that will be considered as engaged in trade or business. The other one is not engaged in trade or business, or an alien foreigner who stays in the Philippines for an aggregate period not exceeding 180 days in any calendar period. Okay, why is it that we need to classify what type of taxpayer is an individual? The reason is that their taxability differs on what type of individual they are, because um, their taxability again with their income will be determined in accordance with the type of individual or classification they belong. For example, if they are resident citizen, if they are RC or resident citizen, then therefore their income within and without the Philippines will be subject to tax. So that means if you are a resident citizen, if you have income earned in the Philippines and earned abroad, then therefore all of your income or your global income will be taxable in the Philippines. Pero other than your resident citizen, like non-resident citizen, resident alien, non-resident alien, are all taxable only to the extent of their income within the Philippines. So that is the reason why we need to classify our individual taxpayers. Because again, not all individual taxpayers are taxed on all their income. So only resident citizen are taxable on its income wherever it is situated or wherever it is earned. Now, we have here the different sources of income as mentioned in our previous video lecture in the basic principles of taxation. We have five sources of income for an individual. First, we have compensation income. This is a compensation payment for services performed under an employer-employee relationship. So, if you are working, then you have an employee-employee relationship, then that will be considered as um, compensation income. The earnings over that employee-employee relationship will be considered as compensation income. We also have business income. So business income arises from all or from self-employment or practice of profession. This shall not include income from performance of services by taxpayer as an employee. Okay, so business income includes first income from operation of business, and second, income from practice of profession. So, practice of a rendering of service of your profession. For example, if you are a CPA, a lawyer, or an engineer providing professional services towards your client. So that will be considered as business income or professional income. These two, compensation income and business income, guys, are considered as active income. Okay, these are considered as active income, and therefore, to compute for the tax due for this type of income, we will use the Section 24A na tax table. And then the other type of income is your mixed income. Mixed income is actually a combination of all types of your income, including compensation income and business income. The fourth one is your passive income. Passive income are income subject to separate and final tax. So these are taxed at fixed rates. So passive income, guys, will be discussed in a separate discussion, in a separate lecture. So if you have passive income, it will not be combined with your active income, because passive income is subject to special tax rates which are final tax in nature. And then we also have capital gains. So this topic is also is or will be discussed also in a separate discussion. But for introduction, we have two types of capital gains. First is capital gains from sale of shares of stocks not traded through local stock exchange. So it's taxed at 15% on capital gains, and capital gains from sale of real property, which is also taxed at 6% on fair market value or zonal value, whichever is higher. In our next video lecture, guys, we will be discussing passive income and capital gains in emphasis. But this time, let us continue with the format of your computation ng taxable income and tax due for active income. Again, it is called as active income, guys, because it requires active participation on the point of view of the taxpayer in order for him or her to earn an income. For example, your compensation income, the individual or the employee will not be earning if the employee will not report sa work. Or in business, if the business enterprise will not open or will not operate, then therefore there will no income also that will be earned. So therefore, it is called as an active income since there is an active participation required sa employee or sa taxpayer in order for him or her to earn an income. Okay, so we have here formats of computation. So assuming that the earnings is a pure compensation, so to compute for your taxable income and tax due, we have here your gross compensation less non-taxable deductions, guys. In a gross compensation, usually gross compensation already includes still includes your non-taxable deductions like SSS, Pag-ibig, PhilHealth, and Union Dues. I know that there are other deductions pa that can be deducted from your gross compensation to compute for your net compensation income or net pay, but what is only non-taxable is only these four items. So take note of that. Only SSS for private or GSIS for government employees, Pag-ibig, PhilHealth contributions, and union dues will be deducted towards your gross income to compute for your taxable compensation income. Okay? After computing for your taxable compensation income, then you will now compute for the tax due using the table in section 24A. So that will be your tax due. Less tax will be held on compensation or possible foreign tax credits or um, tax credits. Tax credits meaning these are, for example, overpayment from the previous taxable year. You could use that as tax credits in the current taxable year to compute for your tax payable or overpayment for this year. So this will be your format of computation if the income is pure compensation. Now let's proceed. What if the income earned is pure business or pure professional? Okay? Business or professional income. So to compute for your taxable income and tax due, guys, we have here your gross business or professional income less allowable deductions to compute for your taxable income. To compute for your taxable income and then compute for your tax due. So tax due can be computed using the table less tax credits or payments, less prior year's excess credits or tax payments for the previous quarters if you are um, earning business, less creditable tax withheld to compute for your tax payable or tax overpayment. But usually, guys, sometimes the problem would not give you tax credits, amount for tax credits. Okay lang kung walang tax credits. So kung walang tax credits, your tax payable will be equivalent to the tax due kung walang tax credits. Pero if tax credits are present sa problem, then you just simply deduct your tax credits towards your computed tax due para makompute nato ang tax payable. Okay? Now, take note, in train law, starting January 1, 2018, when it took effect, it actually gave an option to your taxpayers whether to be taxed at graduated rates or to be taxed at 8% income tax rate. Okay? So, the taxpayer may choose on what manner they may be taxed. They may be choose to be taxed at graduated or they may be taxed at 8% ng income tax. Tax base, guys, if graduated rate ang option ni taxpayer, then therefore taxable income. So here, this will be the taxable income and the basis kung ang option is graduated rate. Pero if the option is Um, if the option is if the option of the taxpayer, guys, is the preference tax na 8%, then therefore our basis would be gross sales or receipt to be reduced by 250,000. Okay? Minus 250,000. So take note, guys, mag-minus lang taog 250,000. We will only deduct 250,000 if pure business or pure professional income. Okay? Iba ang case kapag mixed income, may compensation and then my business or professional. But in this case, if the earnings is pure from business or professional income and then the option is 8% income tax rate, then therefore the basis will be gross sales minus 250,000 times 8% to compute for your 8% preferential tax rate. Now, we have rules on availing 8% tax rate. Gross sales or receipt must not exceed the VAT threshold of 3 million. Okay? So, in order for you to avail of the preferential 8% tax rate, your total sales should not exceed 3 million. Because if you already exceed 3 million, then therefore, you already is subject to VAT. Another is taxpayer must signify his intention to avail of the 8% tax rate in the first quarter of the tax return. If not, he is deemed to have chosen the graduated rates. So kung may intention na to use the 8% preferential tax rate, then therefore it should be um, vocally signified in the first quarter of tax return. Unless, then the assumption would be graduated tax rates ang gamitin. The first 250,000 is not subject to tax since what is taxed is in excess of 250,000. So that is why may deduction tayo sa gross sales na 250,000. Okay? This 250,000 bonus is not available to mixed income earners. So as what I have mentioned earlier, you can only deduct 250,000 if the sales is or if the income is purely from business or from professional income. Now, 8% preferential tax rate is not available to the following. Una, purely compensation income earners. Obviously, kung compensation income lang ang source of your income, then therefore you're not allowed to use 8%. Or kung registered ka as VAT taxpayer, or non-VAT registered whose gross sales receipts exceed the 3 million VAT threshold. Okay, this one, guys. Even if your sales does not exceed 3 million pero VAT registered ka, then therefore you are not also allowed to use 8%. Or not VAT registered ka pero your sales exceeds 3 million, then therefore you are not also allowed to use 8% preferential tax rate. And taxpayers na subject to other percentage tax or OPT. Another is partners of a general professional partnership and those individuals enjoying exemptions. So that is from RMC 50 2018 are also not available or also not allowed to use 8% final 8% preferential tax. Now this time let's proceed with the format. This time, if the income is mixed, okay? When there is mixed income, there is a combination of compensation income or combination of compensation income with business income or with your professional income. So, masa ang ato ang format. So, the format would be just simply add your compensation income, guys. So, obviously, this gross compensation income, it should be net na ha. It should be net of your non-taxable deductions, yung apat, yung SSS, GSIS, PhilHealth, Pag-ibig, and Union Dues. Pero usually guys, if the problem is silent, hindi siya nag-mention ng amounts of your non-taxable deductions, ang gihatag lang niya, what is only given is gross compensation income, then therefore we assume na si gross compensation income is already after of your non-taxable deductions. And then add taxable business income. So you have gross income minus gross business income, guys, minus allowable deductions. So to compute for your net income from business, you just simply add from your compensation income to compute for your taxable income. okay, to compute for your taxable income. And then guys, you just simply compute for the tax due using section 24A kung ang imuhang option is yung kung option nimo is graduated table or graduated rates yung 0 to 35%. So you just add the two, okay, to compute for your tax due. And then less tax credits to compute for your tax payable or overpayment. Again, if there's no given for your tax credit, automatic that your tax payable is your tax due. Now, this time, guys, we have um, two options. We also have two options here. The entity or the taxpayer may opt to be taxed at the tax table, graduated rates of 0 to 35%, or pwede din siya to use the preferential tax rate. Pero, ang preferential tax rate can only be applied to the income earned from business or from practice of profession. So, kung nag-opt siya to be taxed at 8%, then there will be two computation. First is the computation of your tax due from compensation income using the graduated table, and the computation of your preferential tax rate of 8% based on the gross sales or gross receipts from business or from practice of profession. Kung ang option niya is to use the 8%. So duha ka buok ang computation nato kung ang iyang option is to use the 8%. Pero kung option niya guys is kung ang option niya is only graduated, then therefore you just simply add the taxable income from compensation and taxable income from business or profession, then compute for the tax due using the tax table. Okay? But this time, since mixed income man ni siya guys, kung gusto niya magamit ng 8% preferential tax rate, there will no longer be a deduction of 250,000 sa gross sales niya. Okay? Because the 250,000 has already been applied dito sa table. Because kung magamit siya ng table, first 250,000 will be exempt or will have a zero tax due. So therefore, wala nang deduction na 250,000 sa gross sales or gross receipts to be multiplied by 8%. Don't worry because later on as we progress with our discussion, we'll have sample problems of these computations. Now, this time we have here deductions. So deductions, these are items or amounts which the law allows to be deducted from gross income in order to arrive at the taxable income. So if you have noticed earlier, we have items na allowable deductions. We have this line item na allowable deductions. This is being referred to the deductions that are allowed by the law to be deducted in computing for your taxable income. And individuals, not purely compensation earners, may claim two types of deductions or may claim deductions in two ways, not two types, in two ways. First is itemized deduction, and second is optional standard deduction. But for um, discussion, but for this discussion, um, let me just operationally define itemized deduction as the deductions itemized in the problem. Okay, those deductions which are given in the problem. But the details about the itemized deductions will be discussed in a separate video lecture or in a separate chapter. But the other one, the taxpayer may also opt to claim deductions through optional standard deduction or OSD. Again guys, as itemized, yung itemized deduction given in the problem. And the optional standard deduction, how to compute OSD. Now, who are covered, who are allowed to use OSD? The following may be allowed to claim OSD in lieu of the itemized deductions. Meron tayong resident citizen, non-resident citizen, resident alien, and taxable estate and trust. If you have noticed, not allowed to use OSDC, non-resident alien. And at the same time, corporations, both domestic and resident foreign corporations are allowed to use OSD. Now this time, how are we going to compute OSD? How can we determine OSD? OSD allowed to individual taxpayer shall be a maximum of 40% of gross sales if on accrual or gross receipts if on cash basis during the taxable year. So that means OSD is equal to 40% of your gross sales or gross receipts. Now this time, the cost of sales in case of individual seller of goods or cost of service in the case of individual seller of service are not allowed to be deducted for purposes of determining the basis of optional standard deduction. So no need na to deduct cost of sales. So automatic multiply 40% based on your gross receipts or your gross sales. For other individual taxpayers allowed by law to report their income and deductions under different method of accounting, for example, percentage of completion basis other than cash and accrual method of accounting, the gross sales or gross receipts shall be determined in accordance with the acceptable method. But in this case, guys, to compute for OSD for individual, you just remember it's just simply 40% times gross sales, no other deduction, gross sales, before any deductions or before any adjustment towards your sales. Now, let's proceed with um, the tax rate, guys. So this is actually the new tax rate. This is the new tax rate. This is the revised tax rate. This is effective January 1, 2018 through RA 10963 or the train law. So if your income, if your taxable income is not over 250,000, then therefore your tax rate is 0%. If your taxable income is ranging 250,000 to 400, then your tax rate is 20% of the excess over 250,000. Okay? For example, your taxable income is 300,000. So to compute for your tax due, 300,000, that means that belongs to 250 to 400. So 20% in excess of 250. So pila man ang excess, assuming that your taxable income is 300. 300 minus 250, then therefore you have 50,000. 50,000 times 20%, then that will be your tax due. And then 400 to 800, 800 to 2 million, 2 million to 8 million, and over 2 million. Okay? So, you just simply base on this table ang taxable income nga na-compute nimo for computing for your tax due. Okay? Now, let's proceed with sample computations, guys. We have illustration 1. Mr. Adrian, the taxpayer, is married with 6 qualified dependent children. Taxable year is 2019. The following data are available. We have gross compensation of 540,000 and premium payment on insurance for 10,000. Take note of the taxable year 2019. So therefore, we will already be using train law here. So although may 6 qualified dependent si Adrian, but since the train law is already effective here, there's no longer um, deduction for basic exemption of 50,000 and additional exemption of 25,000 per child for a maximum of 4 children here. Since it's already 2019, then therefore no more additional exemptions. And if you have noticed, guys, we don't have any given as to the non-taxable deduction. So therefore, we assume that this 540,000 is already net of your non-taxable deductions. So, compute for the taxable income and tax due if Adrian is a resident citizen. So again, rule if si taxpayer is a resident citizen, it means that the taxpayer is taxable on its income earned within and without the Philippines. But here, isa lang man ang source of income, then therefore we assume na within the Philippines lang siya. So automatic taxable compensation income na to, guys, is 540,000 because again, RA 10963 or train law has amended the basic exemption of 50,000, additional exemption of 25,000 per child for a maximum of 4 children, and premium payment as allowable deductions. for individual taxation. So therefore, your gross income will automatically be your taxable income for purely compensation income earners. So therefore, ang taxable income nato guys will be 540,000. So let's try to compute for the tax due. So balikan muna natin yung tax table. Let's find out where that 540,000 belongs, no? So in the previous table, your 540,000 belongs on 400 to 800 na rate na range. So therefore, tax due is 30,000 plus 25% in excess over 400. Okay? So let's go back with the problem. Your taxable income is 540,000. So for the first 400,000, it is subject to 30,000 and in excess of 400. So how much is the excess? So for 540 minus 400, so there is an excess of 140 times the designated rate of 25%. So 140 times 25%, so that is 35,000. So you combine 30 plus 35, therefore the total tax due of Adrian will be 65,000, assuming that Adrian is only a pure compensation income earner. So that's just how simple to compute taxable income in eventually your tax due. Now, sir, do we need to memorize the tax table? This one, do we need to memorize? It's better for you to memorize, but you are not required because um, in the CPA board exam, or in the problems, we will be giving you the tax table. However, again, for security, if ever uncertainty will happen na hindi ma-include sa given ang tax table, it's better for you to familiarize the table. Okay, let's proceed to another illustration. Mr. Antonio Merid had the following data for taxable year 2019. So Merid, tapos 2019 again sa train law, compute for the taxable income and tax due using itemized deduction if Mr. Antonio is a resident citizen, using graduated tax rate or the 8%. Okay, 8%. Okay, so let's compute for the tax due and itemized deduction using graduated tax rate or 8%. So simply, since the taxpayer is a resident citizen, then therefore it is taxable on its income within and outside the Philippines. So taxable itong income sa Philippines and income from US. So we have here gross business income, total business income of 1,970,731 less allowable deductions. Yung sinabi ko kanina guys na itemized, so yun yung given na expenses in the problem. So we have a total expenses also of 913,000. So therefore, your total taxable income is 1,057,113. So this is an income from business. Okay? Income from pure business. So A, compute for the tax due using graduated tax rates. So when we say graduated tax rate, use the table. No, use the table. So si 1,057,000, asa siya na belong na range? It belongs to the range of 800 to 2 million. So 800 to 2 million. So that means that your first 800,000 will be subject to 130,000 and in excess of 800,000 subject to 30%. So how much is excess ni 1,057,113 sa 800? So there is 257,113. You multiply it by 30%, it's designated nga tax rate. You just again revisit the tax table para makita na to kung asa gikan si 30%. So 257,113 times 30%. So it has an additional tax due of 77,134. So in total, if the taxpayer has opted to be taxed using graduated tax rates, ang tax due niya is 207,134. Its tax due will be 207,134. Okay? Now let's proceed with the second problem, second na question. Assuming that the taxpayer would want to be taxed at 8% preferential tax rate. So since this is pure business, then therefore we will be deducting 250,000 sa ato ang total gross sales. Okay? Total gross sales. So assuming that the gross sales Ang basis nato guys is not gross income but gross sales. So assuming that the gross sales of the taxpayer from Philippines and US are 2,750,000 respectively, so therefore your total gross sales is 2,750,000 less exemption na 250,000 since pure business ito, then therefore what will be multiplied sa 8% nato will only be 2.5 million. So therefore, using 8% preferential tax rate, ang tax due ni taxpayer will be 200,000. Okay? Now, this time, let's compare daw the tax due of the taxpayer using graduated and preferential tax rate. Using graduated, it will pay 207,134. Using 8%, it will pay 200,000. So this is actually an example also of tax avoidance, legal means of escaping tax. So if you are the tax accountant of the taxpayer, then you should advise the taxpayer to use 8% preferential tax rate because there will be lower na tax due that will be paid 200,000 compared sa 207,134 kung ang gamito niya is graduated tax rates. Okay? Now, another illustration. Assuming that the taxpayer is a non-resident citizen, RC, resident alien, non-resident alien engaged to trade and business, NRAETB, engage, trade, and business compute for the taxable income and tax due. Okay, this time, since they are RC, RA, and NRAETB, they are only taxable on their income within the Philippines lang. But although they are taxable only in their income in the Philippines, they are also still allowed to deduct their allowable expenses. So therefore, to compute for your taxable income, you just simply deduct the allowable deductions in the Philippines sa income nila in the Philippines also. So there's a taxable income of 969,113. So dili na included ang income from US since dili man sila resident citizen. So to compute, again, you base it sa table. Guys. The taxable income is 969,113. So still it belongs to the 800,000 to 2 million range. So same, for the first 800,000, tax due is 130,000 and an excess of 969,113 multiplied to 30%. So therefore, the total tax due if the taxpayer is of this classification will be 180,734. Okay, they are only taxable in on their income within the Philippines. Now, assuming this time that the taxpayer is a non-resident alien not engaged to trade and business. Now, there is a special computation when the taxpayer is NRAETB. Okay? It is important to note that one, they are only taxable on their income within the Philippines. So therefore, not taxable ang income from US. And second, they are not allowed to deduct expenses. So if you have noticed in the computation, we did not deduct the expenses, even the expenses from the Philippines. And lastly, they will be taxed at 25%. So 25% is constant basta ang taxpayer is NRA-NETB. So taxable income will automatically be 1,557,588 multiplied to the tax rate of 25%. So we will no longer use the tax table pag ang taxpayer is NRA-NETB. So in short, the tax due will be 389,397 for a taxpayer that is classified as NRA-NETB. Okay. Now this time, let's proceed in an illustration where there's a use on optional standard deduction. Okay? Let's say a taxpayer had the following data on 2019. There's a sales of 3.4, cost of sales of 1.2, administrative expenses of 300, and so on. Okay? Compute for the taxable income and tax due assuming that the taxpayer opted to use the optional standard deduction. Okay? So, kung gigamit daw niya is OSD. So, let's compute. So, first step that we need to do is to compute for the optional standard deduction. So, how to compute optional standard deduction? It is total sales revenues or receipts times 40%. So, take note, we have a sales of 3.4 million plus add other income from operations not subject to final tax. So, we have here, I think this is income from Okay, other non-operating income of 80,000. So it will be added sa ato ang total sales. It should be noted that what will be added is the other income not subject to final tax. So dito, meron tayong income subject to final tax. So ito yung passive income, okay? It will not be added. Ang i-add lang is yung other income not subject to final tax of 120,000. So don't worry because we will also be discussing what are the incomes, unsa ang mga income, ano ang mga income na subject to final tax. So in short, there will be 3,520,000, multiply it by your OSD rate na 40%. So therefore, optional standard deduction will be 1,408,000. Okay? Revenues or receipts arising from incidental or secondary operations of business or profession are added in computing the total sales, revenues, receipts as basis for computing for your optional standard deduction. So since we have already computed for our OSD, then we can now compute for our taxable income. So we have our sales of 3.4 plus other income of 120. So we have a total sales revenues of 3,520,000. So as mentioned earlier, guys, if the taxpayer opted to use OSD, your cost of service will no longer be deducted. You can no longer deduct your cost of goods sold or cost of service. So therefore, your gross income from business will automatically be your total sales revenue, receipts, or fees. Add non-operating income na 80,000, add non-operating income na 80,000 to compute for your total gross income of 3.6 million less your OSD na computed earlier which is 1,408,000. So therefore, you have your taxable income of 2,192,000. So again guys remember na basta magamit ng OSD, you will no longer deduct your cost of goods sold or cost of service. So we came up with a taxable income of 2,192,000. Okay? So therefore, to compute for the tax due, you just refer it to the table. So I think this belongs to 2 million to 4 million, 2 million to 2 million to 8 million, I think. Oh yeah, it belongs to the 2 million to 8 million range. For the first 2 million, it's taxable. Tax it is taxed at 490,000 and in excess na 192 tax to be taxed at 32%. So therefore, total tax due of the taxpayer will be 551,440. Okay? So you could also compare guys, no? You could also compare what if the taxpayer opted to use itemized deduction, which is better. So kayo, you try to compute it yourself. So since nagamit siya ng OSD dito, 551,400 ang tax due. Pero let's say nagamit daw siya ng um what's this? Itemized expenses. So kung ang mga itemized expenses diri guys will be your 1.2, your administrative expenses of 300, and selling expenses na 500,000. So this will be your deductions to be made. Okay? So 3.4 plus 120 plus 80 minus all of these, 1.2, 300, and 500 to compute for your taxable income. So you try to compute. Whichever is lower na tax due will be, will be chosen kay mas lesser man ang tax due na mabayaran sa taxpayer. Okay, so this time let's proceed with another illustration. So ano namang illustration ni siya? I think this is the last illustration. Henry, resident citizen, married without dependent, had the following data in the Philippines. This is an example of a mixed income also. There's a mixed income. Mixed income, compensation of 580, tapos meron siyang business income na 2 million, cost of sales to 750, itemized business expenses of 780, and then passive income. So these are example of passive income, guys. So royalties and domestic dividends. So don't worry because we will be discussing it again later on. Compute for the tax due using graduated tax rate. Tax due using 8% preferential tax. Okay, so let's try to compute now resident citizen tax due using graduated and using 8% preferential. Okay, so let's have this. Using graduated, Okay, using graduated the process, you just simply combine your taxable compensation income and taxable business income and then refer it to the tax table. Okay, meron tayong compensation income na 580 and then we have your gross business income. This is 1,250,000 from our sales na 2 million minus cost of goods sold na 750,000 minus business expenses na 780,000. So therefore, your net income and taxable income from business will be 470. So therefore, your taxable income in total will be 1,050,000. So kung if the taxpayer opted to use graduated tax rates, so you just simply base it sa table. So as a nabilong na range 1,050,000, you base it sa section 24.8 revised section 24.8 table again. So 1,050,000 belongs to 800 to 2 million na range. So that means for the first 800,000, tax due will be 130 and excess of 800 subject to 30%. So how much is the excess? So 1,050,000 minus 800, so that's 250 times 30%. So therefore, the additional tax due will be 75,000. So therefore, we have a total tax due na 205,000 if the taxpayer opted for graduated tax rates. Now, this time, what if the taxpayer opted to use preferential tax? Okay, if a taxpayer has a multiple earnings and opted to use 8% preferential tax on its business income, it is important to note that the computation of income tax due will be done separately for compensation income and for business income. That should be very clear. Okay, so let's compute for the tax due from taxable compensation income. So, taxable compensation income will be computed using the table. So, na siya taxable income from compensation na 580. So, let's base it sa table. Asa na belong si 580? It belongs to 400 to 800. So, therefore, for the first 400,000, tax due niya is 30,000. In excess of 400, subject siya ng 25%. So, 580 minus 400, so we have 180 times 25%. So, there's an additional tax due, guys, na 45. So, therefore, we have a total tax due for your for your compensation income of 75,000. 75,000. And then, another computation for your, ano, 8% preferential. Again, our basis will be gross sales. So, how much is our gross sales? Balikan muna natin ang given. We have gross sales of here, 2 million. So, in this case, guys, since the taxpayer is not pure na business or professional income earner, si 2 million will no longer be deducted 250. Because again, si 250,000 was already claimed diri as a taxable compensation income. Because in the first 250,000, using the tax table, ang tax due niya is 0%. So therefore, no longer deduction of 250,000 dira akay 2 million. So 2 million, multiply it directly by 8% to compute for the preferential tax. So there is a preferential tax for your business income of 160,000. So therefore, your total tax due will be 235 from the combination of your tax due from taxable compensation income and your preferential tax rate. So 75 plus 60, 160. So you have a total tax due of 235,000. Okay? So those are the sample illustrations, sample problem, computations on different cases involving individual taxpayers with different types of classification. Now, let's proceed with the important notes to remember. First, for married individuals, the husband and wife shall compute separately the tax due on their respective taxable income. So there will be a separate computation of tax due. Therefore, there will also be separate um, preparation of income tax return. However, if any income cannot be definitely attributed to or identified as income exclusively earned or realized by either of the spouses, then therefore, the same shall be divided equally between the spouses for the purpose of determining their respective taxable income. So again, if there's an income that cannot be identified, whether it's related to the husband or for the wife, it will be equally divided among the two to compete for their respective share and to be added to their respective taxable income. And number two, in computing for the taxable income, fraction of a peso is disregarded. Okay? For the tax due, a fraction amounting to 50 centavos or more is rounded off as a peso, while a fraction amounting to 50 centavos is disregarded. So for example, your tax due will be 100,000.40. So your tax due will be rounded off 100,000 na lang siya. Pero if it's 100,000.60, so that means it will be rounded off to the nearest peso. So your tax due will be 100,101. And then lastly, guys, creditable withholding tax withheld from income and or tax credit is deducted from tax due. So don't worry because we will also have a separate discussion in terms of withholding tax. You can refer that to the syllabus given to you. Penalties, if any, shall be added to the tax dues. So kung may tax credit, i-deduct ang tax credit sa tax due to compute for the tax payable. Kung merong penalties, it will also be added to the tax due to compute for the total tax payable. And all of these, like si creditable withholding tax o si penalties, will be have a separate discussion. Iba ang discussion ni penalties and surcharges and iba din ang computation ni creditable withholding tax. So I think that's the end of our lecture for taxation on individual with emphasis on active income. If you have any questions, just refer that to our video lecture or you may comment down below your questions for a real-time na answers. Also, you may refer to these different um, resources for supplemental reading. You have the books of Baliada, Valencia, and Ampongan. So that's it for our video lecture. See you on our next discussion and have a nice day. Goodbye and God bless.